section we're gonna do, we just did regular income, now we're gonna do additional income. And I have Schedule 1 written here because now additional income, which used to go just on the face of the 1040, is gonna have its own special Schedule 1. And I'm gonna show you all of those forms and everything later, but just to make a note that this will all be on Schedule 1 together. So additional income, there's a few different things it could be: taxable refunds, credits to offset state taxes, alimony, business income, other gains and losses, rental real estate. A lot of this is out of scope for FIDA, so keep that in mind. If they come to you with other gains or losses, rental real estate, farm income, then you would tell them that you would not be able to help them with that.
Unemployment. Didn't alimony go off? I thought I just.
Okay, so actually, no.
But you
Alimony,
can't claim it?
it's if your divorce took place after December 31st, 2018. So anyone who got divorced before last week can still deduct and claim and report alimony.
Yeah, because I just went on and saw that.
I know, isn't that, so everyone thought it was gonna be this big upset where no one was gonna be able to deduct alimony or anymore. And I imagine Congress was like, I'm deducting my alimony. So they just changed it for the future generations.
So in other words, it won't really affect till next year,
No.
or 19.
Yeah, so anyone who gets divorced after the 31st of December 2018 will no longer be able to deduct alimony, and they will not have to claim alimony as income. So, yes, and I have another thing about that, but these are just some other incomes: non-business debt cancellation, so you need an advanced certification, and they'll get a 1099-C. We see a little bit of that where people's debt gets canceled. That's considered income. And then gambling winnings, they would be given a W-2G. So there's other types of income that are going to be on Schedule 1, but these, I'd say the most we find is probably what, business income and gambling, debt cancellation. Business income, we're still going to do Schedule C's for that, but we'll get into that a little bit, so.
And
Oh, yeah, here it is.
your quality intake interviewer person should be able, if it's out of scope, you shouldn't see
Yeah,
those.
you might not even end
Right,
up with them, but
right.
just so you know that stuff, and especially where we live around here, I know farm income and stuff like that, yeah, they're gonna have to go to someone else for that, so. Business income requires preparation of Schedule C, must be done by advanced tax preparer. Suresh had a really fun Schedule C last year, I remember that.
You'll have to tell us the story.
That was my very first one, I remember.
Yeah.
The guy with the landscape company guy.
Yeah,
And, but he had all his papers, and,
which is good.
which is really good. The only thing what he had is how much he paid for gas. You know, he had that record. There was gas for his truck, and there was gas for his lawnmower equipment. So, and he was doing mileage, and, you know, so I think we got him a benefit by using, you know, a standard, the mileage was 55 cents or whatever the heck it was, you know. So it was 55 cents for his truck mileage, which kind of, if I remember right, I think he got like $800 or $900 more by using that truck mileage and separating the two. And it was kind of that was my very first one last year.
Yeah. Well, so TaxSlayer will generate a Schedule C for you. You're just going to input this information. Ways to know if you're going to end up with a Schedule C and this person, if you get a 1099 miscellaneous and box 7 is filled out, that means that they're probably an independent contractor. We get a lot of those where guys will work for a construction company as an independent contractor, not realize that taxes are being taken out all year long, and then they come to us with this amount that they made. They haven't paid any tax on it all year. So if you're an advanced preparer, you're going to want to help them by helping them get their deductions and things like that. And TaxSlayer is pretty helpful with entering a lot of that in as well. You can still have business income through a 1099K. Apparently this is one you're going to see a lot with like Uber and Lyft drivers. They get issued these 1099Ks. I don't know if we're going to get a lot of those in rural Southwest Virginia, but who knows. Form W-2, statutory employee, so it'll have box 13 checked. That would let you know that they have business income. And then, of course, taxpayer books and records. Most people have those books and records, but I have had people that come in with 1099 miscellaneous, didn't record anything all year, and I had to be like, listen, you need to start doing this. You need to keep everything. But most of them are pretty good about that. So you can advise them on that. Miscellaneous income, cash earned, so people you have to report all of this. Cash earned from side jobs, barter exchanges, awards, prizes, contest winnings, gambling proceeds. And then if they have $600 or more of miscellaneous income, they're gonna get a 1099 miscellaneous, but even if they have less than 600, they still need to report it. They need to report everything. So you would just wanna advise them on that. Don't get a lot of awards, prizes, and contest winnings, but they'll get, typically if it's over $600, they'll get a form for that. And
Under the awards, prizes, and contest winnings, does it have to be cash if it's a card, a Visa card?
yeah, so, and it would even be if you won a prize that wasn't monetary,
It's
you would have to do the value of that. I don't know that we've run into anything like that.
This was bonuses, if a company gives you a $50 gift card, that's actually,
Yeah,
you know, it would probably be like W-2 if you're a company employee, but
pretty much anything they get, they need to report, so. It's just, and that's gonna be on the Schedule 1 now, instead of on the 1040. I think there was a line for miscellaneous income on the 1040. There's not a line for that anymore. There's just a line to put the total of your Schedule 1. Okay, so we went into how you get the income, and now we're going to talk about adjustments, because this is how you get your AGI, which is your adjusted gross income. So it's the total amount of all the money the person's made less these adjustments is your AGI. So there are deductions that decrease the taxpayer's gross income, thus they have to pay less in taxes because it's showing a smaller taxable income. So an increase in adjustments means decrease in total gross income and decrease in tax liability, which is what we want for our clients. Total income minus adjustments, AGI. But it does not, these adjustments don't lower self-employment tax, so keep that in mind. I don't know that we would, well, if you're doing, you might have to do some self-employment tax if you're an advanced preparer.
When they get that 1099 miscellaneous, they'll be paying
Yeah, then they have,
self-employment tax.
so that would be, that's an 8965 or something, is that there's a form for self-employment tax. TaxSlayer will generate that for
Right.
you, and of course, that's only for advanced preparers, so. Educator expense adjustments is a fun one. This changed. It's actually, I think it's more now. Or it might be the same. Is it the same? Okay.
250 about another.
Eligible educator allowed to deduct $250. Qualified expenses were ordinary, necessary. Homeschooling expenses not qualified. Keep that in mind.
Dang it, sorry. I homeschool my daughter.
Sorry, no deduction for you.
Oh,
Oh.
500.
So see, Edis, I couldn't deduct your tutoring.
That's
Shame.
a fun one. And once again, you don't necessarily, you want them to keep the records of, have receipts and stuff for this deduction. And it's up to, so they would need to spend this much. Obviously, they can't just say, well, I did some of it and then take the full deduction. You would want to see that they actually spent that much. Okay, so you would reduce that amount though if they got reimbursed from the school. And this is interesting, so interest that's excluded from US savings bonds or any kind of interest that's excluded, you have to deduct that from that either 500 or 250. If they, I don't know why they make these rules. So if they got a distribution from a scholarship program that was excluded from income, or a tax-free withdrawal from Coverdell education savings account. So just keep that in mind that these things would affect that deduction for them. I'd say the only thing I've never seen Coverdell education, but I have seen people with the interest being excluded from income, so you might find that, and you need to deduct that from that 500 or 250 or however much they're deducting. All right, so we get a lot of early withdrawals for sure. So usually they already pay the penalty out of the withdrawal for the most part, so you wanna make sure to enter that in to TaxSlayer properly, so they're not getting taxed on that, and you're gonna get that in a 1099 INT as well, so if they, and the box will be, which box is it? Early withdrawal penalty, you'll see that on there. And also, yeah, so make sure, yeah, and sometimes, I mentioned this earlier, sometimes, you won't get a 1099 INT, you'll just have a letter from the bank. So just be sure you know how to like read that and look at it. I don't know why that happens. So, oh yeah, so alimony paid deduction, so this technically does still exist, you're probably still gonna have it. It's an adjustment to gross income, so if you pay your spouse $10,000 over a year, you can deduct that from your gross income, and it's like you made $10,000 less. It has to be paid in cash or check, they cannot be filing married at all, they have to be divorced. Cannot live in the same household, there should be a document that they are required to pay alimony. No liability after death to continue payments, I imagine that's some kind of special trust thing.
Where it says paid in cash or check, how would they justify the payments received via cash? Would they just have to, use like bank statements or deposits for that?
Yeah, I mean, I can't imagine anyone wouldn't write a check for that. I think if you're,
Or just for like
Paying
legal
it.
purposes especially?
well, if there's a contract, if they have a contract to pay alimony, and then you would assume that they're doing it, because otherwise the person would take them to court.
Yeah.
So, we don't have to actually see those.
But we don't need burden
documents,
of proof.
You just always have to tell them that, you don't have to prove it to me, but if you
But if
get
you got
audited, you'll have to prove it to
And
me.
then of course it asks for the social security.
Right, yeah. there's-
Yeah, and I got into that, so must have ex-spouse's social security number to claim it. And you are actually required to write in the social security number on the form. So TaxSlayer won't allow you to put in that amount without a social security number, so that will pop up. And this is not child support, this is completely different, so. But yeah, you're gonna keep doing this unless they just got divorced, so. Okay, student loan interest deduction, I know that there was talk of them getting rid of this, they didn't get rid of it though, from what I've read. So, just correct me if I'm wrong. So you can get a interest deduction from your gross income of up to $2,500 for student loan interest. It has to cover qualified expenses for the taxpayer, spouse, or dependents. So it can only be claimed if the interest was actually paid. You can't claim just accrued interest on student loans, you have to have paid that amount for the year. But the person will get a statement showing how much they paid in interest for the year. They're illegally obligated to pay it. You cannot take this deduction if you're married filing separately. And the student, at the time, okay, so the student had to be the dependent at the time that the money was taken out. And also, so this comes up a lot. If you are claiming someone as a dependent who is a student, you can claim this student loan interest deduction, they cannot. So, for all those college students out there, they cannot really claim that typically, if they're under 24 and being claimed by their parent.
What about married filing jointly, and both of them have student loans, and they pay student interest?
So, it's up to $2,500 per student.
Per student, right? So the last one, the student must have qualified taxpayers dependent. This is a taxpayer himself or herself, right?
So, yeah, so if they're just saying that the dependent, you can't just when they borrow this money, they were your dependent as well, when they made the initial contract to borrow the student loan money. I'm trying to think of a situation where you would not be claimed as I guess maybe if you graduated high school and then didn't go back to college and then took out a loan and you weren't a dependent at the time and then moved back in with your parent, then they wouldn't be able to claim that student loan interest deduction because you weren't their dependent when you took out the loan. Does that make sense?
So you have a dependent, and the taxpayer takes a loan for the dependent, right? And the taxpayer gets a, interest paid, so the taxpayer can claim the 2,500 for the dependent.
If the taxpayer's the one who's paying the, no.
I don't think it matters.
No, it
Doesn't
doesn't
matter who
matter.
pays it.
Right.
It's
well, it doesn't
just
matter.
whatever if you're a dependent and you've paid, you or anyone has paid that student loan interest on your loans, whoever you're the dependent of gets a deduction for that.
Right.
Were you gonna say something?
Yeah.
Yeah. Let's say that student loan goes on for 5 years, that dependent's gone, but
You still,
you're still
Yeah.
gonna get a ticket because they were your dependent. When
No.
you took the loan out.
No, not when they're your dependent anymore. This is just saying that if they're they had to have also been your dependent when they took the money out. But then
Okay.
once they're not your dependent anymore, you're not getting that student loan interest deduction. They'll be getting it now.
the borrower is the one who will get the,
Borrowers.
1099 interest,
Yeah.
whatever the.
Well, okay, then,
The parents still paying the
Parents
loan, kids moved on.
the loan is probably, so I'm assuming, I guess the way I'm looking at it is so all my loans are in my name. I had a co-signer.
Yeah,
But they're all in my name,
You're the
so
borrower.
I'm the borrower. So
Yeah.
in most
That's what
cases,
you-
the
it's
student's the borrower, so once they're not a dependent anymore, they're gonna get the student. But yeah, if your parent
Your
took
parent-
out a parent plus loan in their name specifically separate, then they can take that deduction because it's their loan. Actually,
I think the
I
form
don't
comes
think
out
that's
with the
right.
borrower's name on it, so.
you have to be.
Yeah, it's whoever the primary borrower is, correct? At that time. It doesn't matter who pays
Yeah.
on it.
Well, it's more about dependency
Mm-hmm.
than anything.
Because as soon as that student turns 24,
Yeah,
it's done.
then yeah, you can't.
You're right.
But wouldn't the form that you get for the student interest have the borrower's name on it?
Yeah,
So if it's the borrower's name on it, right? So if you, like in your case, for example, you said,
Yeah, then
you
you
were
can
able
take
to
it.
claim it, but if you didn't have any income and you're still dependent on your parent, they would be able to claim that?
yes.
Okay, now,
If they claim you as a dependent.
if you claim you as a dependent, but if you're no longer a dependent, right, and the loan is still outstanding,
Who's,
the paperwork that comes in, that form of student interest, comes in the borrower's name,
it's whoever paid.
Whoever
it.
whoever paid it.
Yeah, once they're not a dependent
Yeah.
anymore, then it's whoever paid. Yeah, I see what you're saying. Okay, does that make
Sorry.
sense?
Oh, we get a lot of those.
Confused?
Yes,
Yeah.
pick up the tab, I'm sorry.
I get the benefit, I paid for it, I want the benefit. They're not even mowing the grass for the.
Alright, so yeah, but that's a big one. I know that helps out a lot of people, and that is just an adjustment from gross
Gross
income, so. True, or false? Adjustments or deductions that increase the taxpayer's gross income? Yay! Cool, alright, deductions, we'll just keep going. So, these are also gonna be, these are not on schedule, that's from, I'll tell you where they are later on when we go through the new form. So, real quick, this is the tax computation. So total income minus adjustments equals AGI. AGI minus your deductions is your total taxable income. And then once you get your total taxable income, then you take credits off of that. So that's kind of how it works. Just a quick overview of personal tax. So total income is the total of all the things we talked about earlier. Unemployment, interest, wages, things like that. So there's two types of deductions, and there's lots of changes that have happened that are gonna affect all the deductions. So they're standard itemized. Only one type of deduction can be used on a return, and you're gonna wanna use the one with the highest value to produce the lowest taxable income. So I know sometimes I will run the numbers through TaxSlayer if they really, really wanna itemize. Typically, most of our clients, itemizing is not a good idea. They'll usually get more by taking the standard deduction, especially because the standard deduction has increased so much now. Only very high earners are really ever gonna want to itemize, but that's not to say, there are some people that have a lot of medical bills and things like that where it benefits them, and if they're so insistent, I'll just run it through TaxSlayer. I'll do it, I'll put in all the itemized stuff and the standard deduction, and TaxSlayer will pick the one that makes the most sense, so, and plus, a lot of times the clients, they've spent all year compiling all of this stuff, and they're so excited to show you that they're ready to itemize, so like, I'll put it in, but I'll tell them, like, you probably don't need to do this.
And one thing on that, the oversight, the person that's overseeing, talking to those people, they need to tell them, you all need to have those added up before you
Oh,
get
yeah.
to the tax preparer.
Yeah, so,
Because, we don't have time to sit there and add up all that.
and I have
mess.
done that,
Yeah.
and that's not,
Yeah.
so,
So
site
we're-
coordinators.
Yeah,
will
site
usually-
coordinator, couldn't think of what it was.
Yeah, site coordinators will usually have them add up the total amounts.
Yeah.
If someone's coming in ready to itemize, they already know what they can itemize, so it's just up to them to give you those
And a
totals.
lot of them won't have them all
No.
added up, so.
I think this is from a PR perspective, I think this is where people are going to have a little bit of a shock, because they still think they can get the exemptions from the other side.
Yeah,
And then when they realize they can't do that, number one, and number two, charity. People are gonna give to churches and,
Right.
Red Cross and stuff, and they got all these paperwork and
you have
voila.
to donate a
It
ton
doesn't-
of money
Yeah,
for
it
it to
doesn't
make a
work.
difference.
It doesn't work, and I think there's gonna be a little bit of kind of angst, like people say, I can't do that, what are you
Yeah.
telling me about that?
And that has been, it's been like that for a while now, where people were so set in their head, I can take a tax deduction
Yeah.
for this, and now, like you're saying, especially now with the 2018 changes, yeah, it's probably not gonna, you're not gonna need to itemize, but you never know, and we'll look into it a little more, so. Standard deduction, I don't even have the amounts here, because that's later on, I'm gonna get to what the new standard deduction is, it's much higher. So it's a dollar amount based on your filing status, single head of household, widower, all of that. And then there's additional, standard deduction for the blind or those over 65 years of age. And then those are the amounts for, depending on their filing status, that you'll add per person that's either 65 years over age or blind. So sometimes, you can note that, on the intake form, if you see that they're over 65 or that they checked off that they're blind. But TaxSlayer will prompt you to say whether someone's blind, and it'll obviously know if someone's over 65 if you put the birth date in correctly. So it should add that, but of course it's good to know these things, and just, if someone says, my refund is, this much less, maybe TaxSlayer didn't calculate it or something was wrong, so I'm just mentioning that. Someone have a question?
Not really a question, but just a statement I've noticed. I prepared several tax returns last year where parents were wanting to claim their children on there that are full-time students, as opposed to the children claiming themselves. And I've noticed, just looking at the math, it seems a lot more better financially for the students to claim themselves to get more back on their returns as opposed to being claimed. Just looking at that, I've noticed that.
Not really.
No.
Because once you get the earned income credit and the you can't get child tax credit, but once you get the earned income credit and that dependent exemption, a parent is gonna get a lot more money back than a student is gonna get back by just claiming themselves. I mean, it's a shame for the student, because they're not getting any,
Yeah.
they're fairly, once they put on their tax return that they're being claimed as dependent by someone else, they're not gonna get a lot back, but the parent will get way more back.
In our office, it's a lot of work, you gotta work 3 tax returns. But we do that for our clients, and we'll show them, okay, so you go pay your kid this much back, give them their money back, because you're gonna come out this much
Way
ahead. But it's a lot of work to work.
And it's important to show them, the different scenarios.
We do that there, but now with VITA, that would take too much time.
Yeah.
And I don't think we can set up
And where we have
2
low,
or 3 returns with
No.
the same social security number.
I don't even wanna attempt that,
No.
nobody attempts that.
Just take our word for it,
No, it does, and, especially where we have lower income clients, that earned income tax credit is gonna be way, because a student is never gonna get the EITC typically,
And
claiming
isn't it-
themselves, so.
I'm sorry,
No,
isn't
you're-
it still that if the parents can claim them, then they are supposed to claim
Yeah.
them?
If they're under 24,
Okay.
there used to be a box
Yeah.
Yeah,
that you check, you know, and the parent.
you would have to have some kind of extent, be like, oh, I haven't spoken to that. They'd have to be sort of not
Yeah.
have a relationship or something,
But then, of course, they wouldn't be living there anyway, so.
Yeah.
they'd be on
so
their
then it
own.
wouldn't matter. But yeah, I know what you're saying,
Okay.
but typically it's.
I just
it's-
thought that just based off of simplicity and, you know, just.
Yeah, no, people get a lot of money back for having college students.
$2,000.
And they deserve it.
Yeah,
If I remember right, I'm just thinking out loud here, but the dollar amount for a single is 12,000, you know, a standard deduction, into right domestic deduction. The dollar amount for married filing joint is 24,000.
24.
Okay,
And head of household is 18.
head of household is 18. So if you have a mother and son, right,
Uh-huh,
and I'm just thinking, following on what he said, if they filed independently, they both would get 12 and 12. Whereas if she filed head of household, they'll get 18.
yes.
So it's better to file,
Well, it's-
assuming other numbers fall in place, because they would get a $24,000 total deduction versus 18,000, and I'm not sure.
Well, it depends on how much money they.
Right, that's,
each
yeah,
have made.
so,
And also,
you have to do it both ways to figure out which
had a
is.
household, they would get maybe EIC,
Yeah,
where if they're filing single, they're,
Assume they don't make too much, is that correct? The earned income
yeah.
credit?
yeah.
But it's a fairly good amount that they can make, if, you know, depending on how many.
If you make $12,000, I mean, all the things, you know, you can-
Yeah, I guess it would be, it might make sense to run it, but it's rare that people come in like, I'm claiming my kid. They're not usually like, should I? They're
Yeah.
usually like,
Right, yeah.
this is gonna happen, so.
Either that or they-
But I mean, if they desperately need to know, yeah, you can try and run the numbers.
There's not too many that they have.
you know, that's on the 50,000 foot level. If the parent makes 12,000, the kid makes 12,000, right? If they file jointly, all other things being equal, they get an 18,000 deduction. If they were to file separately, they would get the whole thing waived off.
Yeah. I see what you're
Except
saying.
the earned income, I mean, there is some tail wagging the dog here in the back end of it, but I'm just thinking out loud.
Well, yeah, I mean, you would have no income, you wouldn't be paying tax on
You
the
would be paying-
12,000, but you also may not get a refund that way. Just because you have zero taxable income, I guess you would get a refund of all the tax you paid.
All the taxes you pay.
But then you would also get that, and you would get the earned income if you filed head of household.
But if they're both making 12,000.
Do we make?
It's
Yeah,
not,
that's-
I mean, these standard deductions are massive.
Massive,
now.
yeah.
So it is, yeah, to have a standard deduction that's equal to what people make to live off of throughout the year is kind of crazy. So, I mean, we won't know till we start preparing these returns for this year. Interesting.
I think
We'll
they said
see.
95% of the people this year will use standard deduction.
Yeah,
That's what
that sounds about right
that's
to
a
me.
projection right now.
I tell you, working for a CPA, he tells me, he says, you guys are gonna have headaches at night.
Yeah.
Much more than what we will have in our
Yeah.
office. Yeah, so.
It's
gonna be-
fun!
Challenging.
Yeah, we'll see how it all plays out, but I mean, that's a good point, who knows with this huge standard deduction,
Right.
so. I guess we'll just have to take it return by return.
We'll get a lot of whining though.
You get a lot of, this is going to be the interesting one, I think.
And there'll be a lot of kids that will go and file their own and claim it themselves.
Exactly.
Mom, dad, or whoever,
Yeah.
even gets to look at
Oh.
the situation.
Also, back to what you said about a student filing separately from the parent, so they can't take that 12,000 standard deduction if they're technically a dependent anyway. So, you were talking about the mom and the son?
Yeah, but if the guy makes 12,000, right? He's
Yeah,
not,
he's not a dependent.
he's not dependent.
Oh, I don't know.
This is when you go home and,
Yeah.
don't sleep all night.
Yeah.
Oh, well, Jan will
This-
take care of it.
We don't know till we
This is the one I have to call Jan at 9 o'clock at night. Jan, I think I have the solution. No, I don't. I'll call you tomorrow.
So, yeah, if you itemized, you can't take the standard deduction. Like I said, you can only take one or the other, and then married filing separately, if one of the spouses itemizes, the other one has to itemize as well. So, just
Yeah, that's-
don't
That's
file
a
married.
that's a stupid law.
Yeah,
Because how are they gonna know what the other one's doing
What's
if
it- mhm.
they're,
And a lot of times they don't.
they don't?
No.
I don't know if he's itemizing, I don't know, you know, so.
it's like, I don't even know why they have it as an option, because they do everything in their power to make sure you can't do it, so, I mean, just take it away, I don't, whatever, so. Okay, so itemized deductions, I said that earlier, kind of apply to higher income individuals.